Okay, welcome everybody. Today we're going to talk about market cycle and what it means, how you can incorporate it into your trading, and how you can benefit from it in the markets. So with our agenda today, we're going to define what a market cycle is, kind of give you guys an overview, a definition of how we define it, how you could build your own framework. So this is not really, how we do it or how Richard does it. It's how you can go out and build a framework of your own, and how it could, you could journal on a day-to-day basis about your own market cycle that you will create at the end of this webinar. How to be on the right side of the trend. That's what the market cycle kind of helps you. The concept helps you stay on the right side of the market, be it an uptrend or a downtrend. And it gives you the flexibility to be on the both sides of the equation and not always be a bull or a bear in the market. And you can, have that agility depending on what the market is trying to tell you. Then we'll get into some of the current market. Richard will cover and analyze the market indexes, the leaders, the current leadership, some of the stocks that are acting well, and then the rally, of course, that we had today, post Powell comments. And then we'll open the floor for questions for anybody that has them. So defining a market cycle. So the concept of market cycle itself, what it boils down to is how do we tap into human psychology and the technical aspect of the market at the same time, right? If we're able to do that, combine the psychological aspect and combine the technical aspect and bring them together, that's what the market cycle is about. It's about, patterns repeating themselves from one cycle to the next. Be it, you could take a market from 2020, you can take a market from 2000, you could take a market from 1970. It's all, at the end of the day, it's human psychology playing out over and over again. And the idea of market cycle is to kind of tap into that cyclical nature of the market itself. What we do at TraderLion is kind of combine, again, the psychological and the technical aspect together, so that we can continuously, be it a trend that lasts 3 weeks or a trend that lasts, a 60-day market down cycle in the markets that we had during the summer. We should always be on the right side of the market. And some ways to build your own market cycle and how you can go about it is, traders like Matt Caruso use the net new high low method. Traders like Mike Webster, they use the S&P or the NASDAQ being above the 21 EMA or daily moving average. And a lot of what they do stems from the fact that they study this historically, they visualize that data, they go, day by day, year by year, kind of visualizing it, documenting it historically, and building their own confidence into their own personal framework that they have for their own market cycles. And last but not least, and something that Ross always says, is the price action of the leaders will kind of always dictate and be the most important, regardless of any framework that you build. If there's no market leadership behind a rally, that rally is likely to be very temporary in nature. It might be good for maybe 1 to 3 weeks. Oversold rally, which we've seen many times this year. But we need solid leadership every time we go into a positive cycle or an up cycle. And we need, if we don't have that, we go into this downtrend, which we've kind of had since early February or mid to late February of this year. Now, how do we do it on the TraderLion side of things is what we call the bolded pivot methodology. This is a system that we've built at TraderLion, and the methodology captures both up cycles and down cycles and kind of tells us, if we're on the right side of the market and if we're in line with what's happening with respect to leaders. Our methodology kind of takes into account volatility, sentiment, seasonality, and momentum, and it boils it down to a singular level on the S&P 500, and which we call that singular level the bolded pivot level. So if the market is trading above that level on the futures market, we're bullish, and if we're trading below it, we're bearish. Now, I want to make it clear that any of these frameworks that you use, at the end of the day, what you have to do is you have to study them for yourself. You have to visualize them on a day-to-day, week-to-week, and a year-over-year basis, and really build your own confidence in them. You could sit and watch someone else tell you something but it's very different when you actually go out and do it yourself and actually, do the homework. Have printouts of the Nasdaq or the S&P with a net high low chart, or the printouts of S&P 500 for the past 20 years, and analyze the fact that what happens when it's above the 21 EMA, what happens when it's below the 21 EMA. So any of these frameworks that you could pick and choose, you could go back and study them, and then basically the market cycle methodology is when, for example, the S&P is above the 21 EMA, you could start cycling up, which is, the day it reclaims it is +1, and then you cycle up +2, 3, 4, and you'll start noticing patterns, and which is how we built the bolded pivot methodology at TraderLion. You could start seeing patterns of human psychology playing out, where you'll see, around day 4 to 6 will be that initial pullback in the markets where we see initial profit taking, and then around data 10 to 12, you'll see that secondary, pullback or stress test in the market, giving you more evidence that is this, trend that's starting to build to the upside, is it sustainable, or is it going to collapse? And how do we know that? We kind of look at the market leadership itself as we go from one to the next. So one of the first and the most important aspects is to journal anything that you're doing. So if you're building a framework, if you're building a methodology, what you want to do is you want to document that evidence so that you can see a pattern, be it, a psychological pattern in the market or a technical pattern in the market. We have to journal and visualize what we're doing. So what we have here is one of the examples that we have from August 2021 is when the market reclaimed what we call the bolded pivot level. Now that could be the reclaim of the 21 EMA or 3 days of consecutive net highs. If you're talking about, other methodologies that exist out there, but either way, the day that your framework or how you define market cycle reclaims that particular level, you could define that as day 1. And what tends to happen is after we see an initial increase in breadth, market rallies a little bit. People that got in early tend to take profits, or that initial profit taken takes place around that day 4 to 6 area. And then what we see is, for me and what I tend to do is make notes on a day-to-day basis to tell me, so I can go back and study this, maybe on a long weekend or on a quarterly or yearly basis, to see how different market cycles played out. So around August 31, which was day 8 of our cycle, after stress test 1, which was the initial pullback after the rally, we saw large progress being made. So I tend to document this, and then you can kind of see the human psychology of the market kind of play out, where we saw, around day 13, we saw breadth kind of shrink just into the big caps, and we can anticipate that, something's off in the markets, and things are about to get a little bit sour. And then the market cycle that started August 20th kind of ended on September 10th, starting a negative market cycle when we broke below whatever framework that you define in your personal market cycle. When you break below that, you kind of start that negative count. So the first aspect of any framework around market cycle is to document and journal what you're doing, to tap into market psychology. And the second is to see that cyclical nature, so that you could see the rhythm or the pattern develop from one cycle to the next. Now, if you run this kind of journaling in a loop and you do it over a span of 1 to 3 or 4 years, you'll clearly see patterns play out, and you'll start trading on. You'll anticipate the market's next move. You'll anticipate where kind of the puck is sliding, and where the ball is going. And that's the state that you want to eventually operate in after you have enough documentation of whatever framework it is that you happen to choose. The second is charting it on the chart itself. So for example, if the market rallied here, in our framework at TraderLion, we reclaimed the pivot right about here, and we lost it right on this day at the open. So we had this smaller cycle right around August, which ended in about early to mid-September. So the reclaim of the pivot, we had an upcycle, and then we lost the pivot. So you're functioning on human psychology, and then you try to visualize it on the chart at the same time. And then when you combine those two aspects, most of the time you'll be on the right side of the market, most often than not. So here's another example of another full cycle and the psychology of it playing out. Now, again, I want to emphasize that the framework that you use doesn't matter. I'm trying to show you the process which you should go through and really, we comment each of these days out personally, see if, leadership is acting well, see if breadth is increasing, see the action of the market, and document that action on a day-to-day basis to tell us if from a psychological perspective, are we expecting a pullback, and from a technical perspective, what are the market, what is market leadership doing, and what are the top stocks in the market doing as well. So in this instance, we saw about, stress test one around day 7 after that initial rally, and then another stress test around day 9, and then we had breadth increase right into day 19 and 20. That's when we expect stress test 3 and 4. So the psychology of it was playing out right, accordingly. But we started seeing distribution come in to the big caps and then the growth stocks right around day 26 to about day 29. That was the time when we started anticipating, okay, that we might be nearing the end of this particular cycle. And then sure enough, by November 26th, we broke below the bolded pivot level and we started that negative cycle. The key part here is to identify whatever framework that you're using. When you reclaim that key level, or the S&P or the NASDAQ, let's say, moves above the 21 EMA, you could document that as +1 in your cycle, and then you document each day thereafter, and you tap into the psychology of the market, and you will see if the 21 EMA works well. Maybe you need to adjust to the DMA, or maybe you need to use a different moving average, or maybe you need to switch to incorporate some more sentiment in your methodology or framework. Whatever it is, the idea is if you document it and you run this process over a span of a year or two, you'll start seeing natural patterns with respect to whatever it is that you chose for your framework. Now, the other way I like to visualize it is, how much, how effective is whatever framework that you chose in the market. Is it, in our current system, you always have to identify your weaknesses and your strengths in the market. Your weaknesses tend to be a little more important because they could tell you that this is when the system is not working, this is when my framework does not work, and you could always downsize during those moments, right? And it can also tell you when your system is working, and you can really position size up in those moments. So this chart kind of shows from October to about late summer this year, this kind of area where we had a 60-day down cycle and about an 80-day down cycle from April of 2022 to about early end of July 2022. We had a 60-day down cycle on our methodology, and it told basically what's that telling us, that we should either be in a primary cash position, right, or be net short the market and have a primary cash position at the same time. So visualizing, this is another way of visualizing to see, what are your uptrends on the market cycle, how long do they last, and what are your downtrends in the market cycle and how long do they last. And also identifying these weak spots is probably more key than identifying these streaks, because they tell you that, if it's choppy and you're seeing a cycle of 1 and then it goes negative and then +1 and then goes -1, that's a system weakness that you need to focus on, and that's where you need to improve your framework. And we're no different at TraderLion. We tend to focus on the same things, and we continuously improve these systems. So what I tend to, what we see here is right about in the October, November area last year, we had a big upcycle of about 30-35 days, and things have kind of never ever been the same ever since. So it kind of started in November, and then it got really bad in the Feb area where we saw multiple 20-25 days, and then the biggest one coming over the summer of about 60-day down cycle, where you either had to be in a cash position or be some net short for you to make large progress in the markets. So visualize it whichever way you want. You could do it the journaling way, which is this. I encourage you to do this. It will visually show you, and you could document, right? The columns that we have here are nothing special. It's just the date, the count of your market cycle, what stress test. So the first pullback that you see in leadership stocks qualifies as stress test 1. The second pullback you see qualifies as stress test 2. When you have multiple stress tests kind of combine or cluster, which is very similar to, you could say, distribution days piling up, that's when you can anticipate that the market cycle is about to end. The other way is I like to see it over a span of, a couple of years. What are the areas where things tend to be choppy? I tend to focus on the system weakness, downsize in those moments. If I see a lot of continuous chop around my a personal framework, I tend to downsize and limit my size in those environments. And then if I see a streak in the market going, +3, +4 in the cycle, then I get really aggressive and try to make progress to the upside in these moments or in these moments, which were basically or essentially oversold rallies that we saw in the markets on a temporary basis before things rolled over to make fresh lows. Now, analyzing market trends. So this is another one that
Ray, before we move on, actually,
yeah,
there's a few questions about whether you could elaborate a little bit more on how you basically define a stress test. There are a lot of people who are kind of confused about that terminology. So I'd love if you could kind of expand on that a little bit.
Yeah. So with stress tests, so let's say the market rallies and there's a leadership group. Let's just pick, for example, the solar space, right? The solar space has kind of been the stronger space if you look at it from a holistic perspective, or the oil and gas space has been one of the stronger spaces in the market. And if the indexes are pulling back and you have a net down day in the market and things on a net basis are pulling back, you want to see what your leadership stocks or your best stocks in the market are doing. That can be from a growth perspective, from a value perspective, whatever your investing or trading methodology is, regardless of that. The word stress test is you're looking at leadership on down days in the market to gauge how that what that leadership is doing. So when the indexes pull back, that's a stress test on the market, but you want to look at your leadership stocks to see how they're acting. If they're acting and they're pulling back, for example, the NASDAQ is down 2% and the leadership stocks are down 4.5%, 5%, that tells you they're not exhibiting any relative strength, right? Distribution in the market is equaling distribution in leadership stocks. What you want to see is on those pullbacks is if the NASDAQ is down, let's say 1.5% to 2%, what you want to see is those leadership stocks maybe even they equal the market. If not, they're down 1.5% only. That's the scenario that you want to be in, because you on those pullbacks in the market, you could start accumulating more shares if we see that scenario kind of develop. If you don't see that, where NASDAQ is down 2%, stocks are down 4, 5, 6%, that means that the distribution in the market is real and the stress test is not constructive in nature for a secondary rally to happen. So those days count as kind of key evidence, where you collect your evidence, you go to your leadership groups and say, how are my best stocks in the market acting? If they're acting good, then you can start accumulating more shares. If they're not acting well, you kind of play defense. And those are key information days in the markets, and the best days to gather a lot of evidence so that you could either increase your exposure or completely decrease and play good defense in the market itself. So I hope that kind of answers it for you.
Yeah, I think it does.
Awesome. So another example that we have is basically the NASDAQ with the lime green line right about here. So it's a very simple way to define a market cycle. You could do the same thing where, since let's just take Feb 2022, for example, or November of 2021, when things started to get choppy, much of the time that we've spent in the markets has been below this 21 EMA. Now, if you just do, your homework since November of 2022 to the current markets, you'll see that you would have been on the right side of the market most of the time, because your market cycle count would have been negative, if not, majority of the time that we traded from about November 2022 to December at the moment. So this is another very simple framework that you could use. You could do a bar by bar, even build a Pine script in TradingView to kind of tell you that, to do that count, and it will keep you on. If there's a if there's a major downtrend, you'll be in cash or a net short position, and if we're above it, you should be at the very least have that first position up, maybe with 8 to 12% exposure, and see how it goes, and then use the principles of financing risk and progressive exposure to build that second position to the third, fourth, and fifth, so on and so forth. So Richard, if you want to add anything about the net high lows at the bottom
Yeah.
or with the 21 EMA.
Yeah, so first, there was a really good question that came in from Tony. Is it best to view the NASDAQ or S&P 500 to determine the health of the market? I would say look at multiple indexes. Some of these are going to reflect more one area of the market. Some of them are going to emphasize what the mega caps are doing. You also want to look at equal weight indexes. So take kind of a broad view, and I look at basically six major indexes each weekend and each day to kind of get a sense of what the market did. So that's really good. You want to get that nice overall view and try not to be too biased based on one area of the market. Just to explain the chart a little bit more, the orange line, which is the shortest term moving average, is a 5 SMA. The longer term moving average is this black one, which is a 200. The blue line is the 50 SMA. And then, as Ray said, the green line is a 21 EMA. Now, when you're first starting out and trying to build a system to define a market cycle, I would say just focus on one or maybe two of them and write definite rules based on, are we above or below increasing or declining moving averages, and how do you use that information to define whether you're in an up cycle or a down cycle. Once again, it's not super important about how you define it. It's about having a process that works over time. When I first started learning about this from Dr. Wish, he defines a market cycle using the 30 SMA, and he's got some rules about that. It's all about, being consistent and, tracking that and seeing if it actually works and helps your process. So as Ray mentioned, and Stan Weinstein, who we worked with over the summer, is huge on this, the net new high lows on both the NASDAQ as well as S&P 500. That's another very useful indicator. You can see that even before we really broke down here on the index, we started seeing a large increase in net new lows. And that trend has pretty much continued throughout the entirety of this year. And this is something that Dr. Wish looks at a lot as well. If we're the type of traders, a lot of us are Ken Slim style traders who like to buy new highs, we probably want to be trading most aggressively in a market where there are a lot of net new highs. That just kind of makes sense. So think logically about this and try to use these different indicators and combine them to form a system that's consistent and helps you out. And basically how I interpret this chart here, let's take it step by step. First, I look at that 200 SMA, the longest term moving average. This gives you a sense of, on a larger time frame, is the market under accumulation or distribution? And for a lot of the previous years, we were above a rising 200-day moving average. That switched this year where we started to see it flatten out, and now we're below a declining 200-day moving average. So that longer term trend, even though we're making a short term run at this, we're in a short term rally at this moment, we're still below a declining 200-day moving average. So that kind of puts things into perspective and gives you that situational awareness that even though we're acting well in the intermediate term, in the short term, we might not want to be completely diving in on every sign of strength, because we do have that larger term context. Now, the 21 EMA and 50 SMA I use kind of together to identify that intermediate trend. If we're above a rising 21 EMA, I'll be looking to add exposure on swing trades, position trades. Same thing with the 50 SMA. And then the 5 SMA just kind of gives me a sense of, in the very short term, are we experiencing a little bit of a strong trend, or are we kind of chopping around? Once we're, undercutting that level and moving above and below it, we're kind of chopping around, consolidating, but we're just now pushing above that level. So if we can stick here and then move up and continue to push towards that 200 SMA, that would be very constructive above all those moving averages. So I like to put all these different, basically these 4 different timeframes together to identify that larger term trend and the overall situational awareness that I use to guide my trading. So that's pretty much it for this slide. Let's go on to the next one, because the indexes don't just tell the whole picture. Ray, if you could move to the next slide. We also want to be looking at the stocks themselves, the market leaders. As Ross says, and has told me so many times, watch the leaders, watch the leaders, watch the leaders. They'll tell you everything you need to know. So here on the left-hand side, I've got a chart of Net Cloudflare, which was one of the leaders in 2020 through 2021. We had this amazing run here where it had a little bit of a climactic end to it. And then we see it undercut the 21 EMA, then the 50 SMA, and then it undercut the 200 SMA. This is where the trend really changed, the character changed. We start to see large declines on high volume, suggesting more volatility, basically suggesting a change in character. And we want to pick up on that and identify that, because that is telling you that this stock is being distributed And when this happens, not only with one stock, but an entire industry group or entire kind of theme, as we saw with the tech stocks, that's something you want to take note of. And if you're in those stocks, be very careful and basically follow your sell rules and look for spots to exit as the stock continues to break down. So that's what happens, when leaders top, and they can top a lot further and fall a lot further than we think. That's why we have to manage risk. But on the flip side, when we're looking to identify a positive trend change where we've been in a correction, we've been in a bear market, what does a leader breaking out look like? Well, here's a chart of FSLR here on the right hand side, where we've got a large breakout on huge volume through this resistance area. It also broke above this pivot as well. And this has been one of the leading stocks in the leading groups this year, solar, and it continues to outperform and trend above the moving averages, even as the market, the NASDAQ, the S&P 500 makes lower lows, this makes higher lows. So we're looking for those divergences and stocks that are leading the market, because that's a really important thing. Leaders lead. Both they'll basically top before the rest of the market does, and they'll also break out and move higher before it as well. So you kind of want to judge the market conditions on two different things: the market indexes as well as the leadership. And using those together, you'll have a great interpretation of whether you should be stepping on the gas or kind of tailing things back a little bit and protecting your capital. Anything you want to add on this, Ray?
No, I mean, I think one of the points is leaders don't make excuses, and this year has kind of been the solar space. Confined areas of the market. There have been times where oil and gas has been really good. There have been times, very very few days where the semis try to come back, but then get slapped down. But primarily, it's been always the oil and gas or the solar space kind of leading and taking, turned one week or the other. And what you want to do is, if you focus on, at the very least, the top 10 or the top 15 stocks in the market, it will just give you an opportunity, even if, this year's overall has been very choppy. One day you can have a massive update. I think we've had a 7% rally in the NASDAQ, right? Based on news. We close at, high closing range, high volume, things shape up. And then you could say 3 days later, we're back below those lows, making fresh lows in the market based on some news or CPI event, or all the fundamentals in the world kind of matter now. So you have to pay attention to news and a lot more variables. So in these environments, I mean, me personally, if anything, I try to get bullish through index funds for starters, and then see individual names, see if they start trading a little bit cleaner. FSLR is a really good example this year of something that has worked throughout the year, and the solar space has kind of made some progress, but it's not all names in the solar space. I can name you about 8 to 10 others that haven't done well in this space, or from an alpha perspective, or a net return or a year to date performance, they haven't done well. So you really have to be in tune with the bigger trend in the market, which I think is the declining 200-day. When the market's in an uptrend, we personally, everybody tends to say that I will never trade a stock below the 200-day. And then when the market is in a multi-month downtrend, all I see is individual traders trading stocks below the 200-day, right? So you want to focus, stick to what stick to your fundamentals. Yes, it's a tougher time, and it's very, maybe we've seen pockets of strength here and there, but overall, I could tell you, we know folks that manage multi-million-dollar accounts to $1 billion accounts that are all kind of struggling in the same way, because there's no traction. It's all dependent on news. You don't have this steady trend above your MAs, or for example, even if you talk to Stan Weinstein, it's not that easy. It's really a hot mess at the moment. We might get, today's rally that we've got, we've now kind of have to wait and watch to see if it sticks. Yes, we've made some progress off the lows, but overall, the nature of the market, if you pull up an ARRY, it's not clean off the pivot. It's not making major progress. You kind of have to be very, very patient, kind of slowly build your position, or maybe to only see it, come back and hit your stops. So it's that kind of year. It's frustrating, but you have to ride out, these kind of years, preserve your capital, so that whenever it is, when it does, you see the other side of that tunnel, and you have that cash flow, that many traders have kind of wasted, you'll be ahead of the game, because that 1 year or that, that will be, a little more steady, will give you a little more room for error per se, you will make a lot of progress in those years. So I think overall this year, I mean, if you're a really good stock picker, maybe you're up double digits. If you're up triple digits, kudos to you. But overall, it's been very, very tough for the average trader or even some of the bigger accounts to make bigger progress or even hit double digits or closer to that triple digit mark.
And there were a few good questions that came in. First, from Mike, have you studied using stage analysis to gauge the market cycle? I definitely incorporate that into my process. I like to look at the weekly charts as well. I haven't studied it extensively, but it's part of that larger term context. And for me, based on my time frame, the shorter term moving averages make a little bit more sense, just because I'm not usually trading off of weekly charts. I should do that a little bit more. But for kind of swing trading, I think short-term moving averages and using those to define the market cycle, makes a little bit more sense. But I always like to have that longer-term view. I also saw a question from a few people, basically, how do you define a market leader? That's a whole nother webinar in of itself that I think actually I'm going to do with Ross later this week. So make sure you take look out for that. But very briefly, it's a market leader is a stock that, first of all, it's got to have very strong price performance. If a stock doesn't have strong price performance, it's not really a leader. It's got to be leading the market. It's going to be trending above its moving averages. It's going to be breaking out on large volume, pulling back on lighter volume. It's going to have all those kind of A plus price and volume characteristics. But in addition to that, you also can apply the CAN-SLIM framework to different stocks and look for stellar earnings growth on an annual basis, quarterly basis, sales growth. You want to look for that N factor, that new and innovative product. You want to look for all those different CAN-SLIM metrics, and that's kind of the fundamental side of things that you can also apply to define a leader. So, like I said, there's kind of two main things. There's the fundamental aspect and the technical aspect, and kind of when they kind of come together, that's the ideal scenario. If you look at Tesla in 2020, it had the industry group working, it had triple digit earnings growth, it had superior price performance. When all those things combine, liquidity as well, when all those things come together, that's when you can have a really stellar run. And also when, of course, there's an amazing market backdrop as well. Ray, anything you want to add about finding leadership?
I think in a downtrend, you need to focus a little more on weekly charts because the daily action is very choppy. It's very news based. It's very macro analysis matters more. Who's saying what? How many Fed speakers are talking today? You have your economic calendar up, uh, and so on and so forth. So I think weekly charts matter a little bit more, and especially when you're in a downtrend, they tell you what the key areas are, especially when you kind of zoom out and see the weeklies, how the base is developing, right? One of the concepts that Ross has taught me is the weekly base count. So you take, you look at the structure of the base, you identify the accumulation weeks, you identify the distribution weeks, and you see if on a weekly basis, as the, within the base, are we seeing net accumulation or net distribution? And base your decisions on that eventually when it does break out of that base structure. So that is one of the things that I feel is a little more important. Dailies will always be there. Everybody wants to be fast and quick and grab, market opens at 9:30, they want to be done at 10, extract $6,000 in profit, go on a walk and come back the next day type of style. But that style is tough. It's stressful. It's not a lifestyle that you can maintain for a very long period of time. So I think weeklies matter more, especially when the 200 days curling down still. Look at your weeklies, look at the net accumulation within the bases. That will tell you a better story about which stocks are going to, are accumulated and are ready to double and triple if and when we get a solid uptrend. And that solid uptrend is not one day where the Nasdaq's up 7%. The next day matters a lot more. So tomorrow matters a lot more in terms of that initial pullback. Do we see some of the stocks that have been holding up? They continue. They don't care about the market pulling back. We see decoupling. That's what we call it. When the indexes are pulling in, but the leadership in the market is making new highs. So you see that decoupling effect kind of take place. That's what we've been waiting for in the markets. We haven't seen a lot of that. Maybe we see a day or two, but then you see that news kind of hit and all of that stuff come down and cater down at once. So be patient. If we have this big update in the markets, look forward to the next day to collect evidence, right? There's always going to be a pullback. The market's not going to go up 7%, 3%, 3%, 3%, all the way to all-time highs. That's just not how it works. And it's never going to happen. It will pull back, give you chances, give you enough evidence. You build a solid case for you to get involved in some of these leaders. Leaders will give you the chance to get involved. They'll make it very, very obvious. I just feel many traders just on a net basis are just not patient enough to wait for their environment to kind of develop so that they can position size to catch up with respect to performance in the market.
Yeah, and I saw a question come in, as Ray mentioned, looking at a weekly chart and judging accumulation versus distribution. Very quickly, I'll probably make a video on this and post on the TL channel. But very quickly, you're within a base, and you're looking at a weekly chart, and you look at the closing range of a bar, and if it closes, in the bottom third on above average volume, that's a distribution week. If it closes in the top third on above average volume, that's an accumulation week. And then you keep track of the number of accumulation weeks, distribution weeks, and you basically subtract them. And if net there's more accumulation weeks than distribution weeks, that's good. That's a positive sign. But if it's kind of the opposite, maybe that stock net is being distributed and it needs more time, or something. It's not quite ready to really make an explosive move. So very quickly, that's how you do it. Yeah, I think we can move on here, right, to the next slide. I think we talked about a little bit about the current leadership. So up here, potential leadership groups. This is basically a list of areas of the market that we're focused on over at TraderLion, and this is published every weekend in the TraderLion report, which Ray and Ross combined put together to identify the top stocks, the top areas of the market, and they also give you an overview of their market commentary. This is basically the list from the most recent weekend. You can see, many of the themes we've talked about: energy, solar. We've got some, semis popping up here as well. And basically, to create a list like this and to build a watch list, you want to look for themes. You want to look for areas of the market that together are acting well. You want to look for strong technical actions such as gap ups, breakouts on large volume. The larger, the better. You basically want to look for those character change technical characteristics. Also, of course, you want to see, many stocks within a group making new highs. That's the most bullish thing that can happen. So all these combined are basically things that you should look for, and they can help inform you about, what is the current leadership, what are the current leadership groups. Yeah. Anything you want to add on this, Ray?
No, probably, the majority of the crowd is kind of waiting for the markets to develop some sort of sustainable uptrend. We've seen these oversold rallies of about 15 to 20 days where you have these windows to make really good progress, but then you have to really pivot back and play really good defense for you to keep any of those gains. So for me, I guess into the end of the week, like I said, that first pullback will give you a lot of information. It will give you a lot of evidence. You collect that evidence, and then that reflects in your position size and conviction that you have in your next position. So I rather be, something that me and Roth talk about a lot is, that first position that we put on has to make progress for us to put on another position, and then kind of finance our risk and roll the sum from one to the next, so that if they were to even, cave in all at once, at the very least, we don't lose any money in the markets, and we keep kind of that flat line on our P&Ls on a year-to-date basis. But there will be a time and place where the market will give you ample opportunity to continue to buy stocks and increase that exposure from one position to 7 positions. So be it. But we need to be kind of patient, wait for that to develop. Still kind of iffy. We have these, the odd biotech run this year, which has been very profitable, the odd solar space. But all of it boils down to you have to be patient for you to really get to, I've had trouble personally, the way I've traded, to get past 3 positions this year. I get to the first one, profitable, second one, okay, making some progress. And then by the time, momentum kind of tapers off and you really have to just flush everything out for you to continue to, make a little bit of progress from one market cycle to the next market cycle this year. So I think, continue keeping track of it, keep your bullish plan or whatever you look for on the upside, keep it the same, keep doing your routines, keep, doing your homework, make sure you're prepared And whenever it happens, anybody can kind of have that crystal ball and, sell you anything and say that, okay, today's rally was the bottom or whatever the case might be, but nobody really knows what is going to happen next. So we just have to take it day by day, analyze that information, look for that pullback on those stress tests or down days, look for evidence, collect it, build conviction, try to roll your sum to the next position and try to build, just stick to the fundamentals of what made you money in the past will make you money in the future. It's just it's a matter of patience, or it's a game of patience to keep whatever gains you made over the last 5 years, keep them, you keep that equity curve intact so that whenever it happens again, you could continue making big progress in the markets.
Yep. And I think the next two slides are just two stocks from the past TraderLion report. We'll go through these really quickly, just kind of gives you an example of what we look for. We've got an initial thrust off the lows here, and then a nice basing structure, and then a pretty clear pivot as well, which, you've got downtrend line, and we've got the low note here from Ross as well as we begin a relative strength phase. So I don't want to spend too much time on this because I want to get to your questions, but we can just go to the next one here. I believe it's ISRG. Similarly, we've got a really nice thrust off the lows, gap ups equal power, nice volume coming in as well. Then really nice tight action holding. I believe this is the 10-day moving average here, and you've got the lineup of this longer term trend line as well as the short term pivot, and this push through today as well. So yeah, that just gives you kind of a sense of what we look for and what we put in the report. And I think that's it. We'll probably move on to Q&A. Ray, you can probably move on to the next slide. People did have some questions about private access and some other things if you want to walk through that.
Yeah, so private access, just to summarize it, is kind of a program built to give you structure in your trading, to give you some sort of framework to operate on, to help you build routines, what to do on a daily basis, nightly basis. The program's built in a way where we want you to kind of come in, learn, structure your trading, and then go away. So it's kind of, you year one, you kind of learn the basics of it, of what it takes to be a successful trader. You build your own workflows, you build your own kind of, framework. You become a consistent, steady gains. You start to build consistency, and that takes a couple of years. And then after that, once you've developed a setup or two, you become a self-sustainable. That's when you really don't need private access on a day-to-day basis. You kind of are on your own after that. We also have a few partnerships with Oliver Kell, who was the 2019 or 2020 champion, 2020 US investing champion. We partnered up with Stan Weinstein, which was an amazing course that we made with him on stage analysis, how he views the current markets after he wrote his book many years ago. And then from a psychology perspective, which I feel is the most important after you master consistency and develop a setup or two to look at in the markets, psychology becomes the most important. So Jared Tendler is the fellow that we partnered up with. He has a book, amazing book as well, that you should check out. And that's what we have from a Black Friday perspective. I think we could take questions now, Richard, from the Q&A tab.
Yep. Give me 1 second, just finishing out this here. And I think the private access, I mean, that's a pretty good deal, about $1 a day. That's pretty darn good. And just recently we've been starting something called the theme of the month, where very similar to this, we cover a trading concept. Last month, I forget what it was, but basically we cover in depth a concept, give a presentation. I write a thorough article as well, and it's a great way to get some evergreen lessons there as well. And yeah, let's go ahead and move on to the Q&A. Yes, I think we'll make these slides available as well. Shoot me a DM on Twitter, or shoot me an email at richard@TraderLion, and we'll get those to you. Yeah, go ahead.
There's Oliver Kell, you can follow at 1charts6, I believe is his handle. If maybe he changed it, but you could follow him on Twitter as well. He posts charts, and you could look at the commentary. Really nice fella, and really knows what he's doing on a day-to-day.
Yep. And there's a question here from Craig. Ray, you went long today when we broke the BP. Was your choice in position size any different because it was a news driven event?
No, it wasn't any different. So today, the market cycle from a trader line perspective reclaimed a level of interest on the S&P futures market. So I initiated a position with, shorting the SQQQ, which ended up being up 7% on the day from my average price. So this is day one of the cycle, or our current market cycle. Now we're on the count, is now +1. Now we'll see, how the rally kind of takes place over the next couple of days. If we get to day 4, we'll kind of see that initial pullback, and we just work the psychology. And in the market cycle, we have documentation on it for many months that you could go back and study on your own. And everyone within private access is kind of functioning within themselves. It's not really, I'll tell you this, it's not a babysitting service. It's not an alert service. We have a system. Everybody knows a system. We have a daily plan. It's posted 2.5 hours before market open. Everybody, when the market opens, executes on their own. They go and focus on what the game plan is. And then at the end of the day, we kind of regroup and talk about what we did or the actions that we had in the markets, and kind of analyze and give each other feedback. So today was, day one. Me personally, I don't tend to be super optimistic of, this is the bottom, this is this and that. Take it day by day. We'll see what happens tomorrow. I'm looking forward to that first pullback, see how leadership acts on that first pullback, and kind of take it as it goes. I hope that answers the question.
Yep. And I see a question from Gabriel, who's the person you partnered with, who wrote the book about stocks and psychology. That was Jared Tendler, who wrote The Mental Game of Trading. And he's a fantastic teacher. And what I really like about his process when it comes to trading psychology, it's kind of very similar to how we approach trading and trading stocks itself. It's very systematic. It's regimented. We provide in that class a lot of worksheets that you work through and build up your trading psychology system. Just like we've got a trading system, he kind of helps you develop that trading psychology system, which allows you to, manage those emotions and actually use them to your advantage. So definitely check that out, especially if you like the book. I think we go into even greater detail, and it's very much like a one-on-one coaching session with him. So definitely go ahead and check that out if you're interested in that. Let's see. Really inspired by YouTube previous webinar when Ray talked about the equity curve. Can Ray explain how he scales up his position without breaching his total portfolio risk limit, say 1.5%? So I guess a little bit about progressive exposure would be great here.
So there's a whole video on it, but so the idea of I'll speak to the idea a little bit so that everybody's on the same page, and then we'll maybe go into a very specific example. So the idea is, if the market is good and you're looking at leadership stocks, and you initiate positions in those leadership stocks using a specific edge or entry tactic, the market wave that kind of begins, which is the first day of the market cycle itself, there's a lot of momentum. There's a lot of breadth that, the increase in breadth on an aggregate basis. And given that you've, studied your edge, studied the entry tactic, and your market cycle aligned, so those are the 3 factors. When they all are pointing in the same direction, you'll get momentum in the markets. That's essentially what you're trying to do as a technical trader, or as a momentum trader, or however you want to label yourself, right? So let's say that first position makes progress. That's the first assumption you have to make in this concept, is that first position makes progress. Now you kind of have, let's say we have an open profit of about $1,500 to $2,000, or let's just keep it round. Let's say we have an open profit of $1,000. The way I'm thinking about it is, I can risk $1,000. I can go in the market, risk $1,000, right? Make a bet on the open profit that I have on my next position to see if that works. And if that works, then I have an even larger sum, or larger, amount of, dollars to waste, versus my baseline of, let's say that your account's at $25,000 when the market cycle hit +1, and you initiate that first position, you make a little bit of progress, and you have an open profit of whatever, $1,000. You go and, you take that next leader, you take that next entry, your edge is showing, you take that, and the market gives you more feedback and says it rewards you. And it says there's more momentum, there's more juice behind this rally, and it gives you a bigger profit. Now you scale from one position that was doing well to two positions that are doing well. Market's giving you positive feedback, and you're progressively, investing your money as the market gives you feedback. Now, the other scenario here is you put on that first position. Let's say you're up $800, and you put on that second position and you get whacked. You absolutely get whacked, and you're, instead of it adding a couple $100 to your open profit, now you're down $100. That's the market giving you feedback that there's something that is wrong with the market. There's nothing, if you have a proper system or a proper base, or, a real methodology that you operate on, the market will always give you proper feedback at the end of the day. And you have to listen to that feedback. So if you're exercising progressive exposure and your second position says, okay, you just need to stop and slow down, you need to listen to that and kind of, you decrease exposure, you flush it out, and you say, okay, something's wrong with the market. It's not aligning with my system. So I need to pull back and be a little, play good defense, so that whenever it is, whenever that may be, that the market's now, in my, operating the way that I can, profit from it. You kind of wait for those moments again and again in different market cycles to continue to make, progress on your equity curve. So I hope I made sense. I did a lot of talking with no visuals, but that gives you an idea of what progressive exposure is, how you can take a look at what the market's telling you, use that as feedback to be aggressive or play defense in the market. Awesome.
Yeah, I think that was good. Let's see here. Question for today's action: how do you interpret moves today made by possible leaders on larger volume relative to others in the same space? Thinking FSLR versus EMPH.
You want to pull those charts up, Richard, or you want me to?
If you can, if I pull them up, the recording kind of gets messed up.
Okay.
While he's doing that, make sure to put in any questions you guys have in the Q&A section. And first of all, thank you guys so much for sticking with us to this point, and some great questions as well, great comments as well. Let's see here. Yeah, so there's a question from Kevin. The IBD power trend in effect and a big bullish move today. Is the bull market back? We'll have to see. But I think the IBD power trend is another great example of how you can define a market cycle. Remember, we're talking about the larger concept here, not, I use this system, I use this system. The power trend is great, and it was created by Mike Webster, who really did his due diligence, and he came up with the 21 EMA and why it's so useful, which I personally use. So that's definitely another very valid way to define a market cycle.
So let's take a look at EMPH.
I'm not seeing your chart yet, by the way.
Oh, you're not seeing my chart. Okay.
Yep. You have to share again.
Okay, are we good now?
Yep, we're good.
Okay. So on the right side, we have a chart of the EMPH itself in terms of estimates and sales. It's kind of all green. Future estimates also are looking good. So, and this happens to be in a group that is continuously making progress in the market on a net basis. So for me, EMPH is trading a little bit still within this consolidation area. It's still a little bit choppy, which is why I like to look at weekly charts when we're really in a major downtrend in the market, and we're still in a declining 200-day per se. The weekly charts will give you a better picture, right? If you place the 10-week line, as long as we're above the 10-week line, that's positive action to the upside. But eventually, I want to see this 326 break that to new highs. That will be the real story here, and for you to get aggressive. For me, the time frame that I trade, I want to be able to buy position. I want market momentum behind me. I want group momentum behind me, and I want it to move away from my entry area as quickly and as fast as possible. So let's take a look at FSLR. Sorry, FSLR. Oops, FSLR. There we go. So FSLR is a little bit better, I would say, because there's no overhead resistance. It's right near its highs. There's no major consolidation that has to get through on a weekly basis, and it's trading a lot better and smoother, above this 10-day as well. So I would prefer FSLR, it has exhibited a lot of relative strength on the net basis. If you just count the amount of RS days that it's had while the market kind of pulled back in, you'll see that this is under consistent accumulation and continues to go to the upside, and it has little overhead resistance, whereas EMPH is a little bit, it's within a larger consolidation. You'll need a little more buying or power to get through that area to really make progress to the upside. Richard, you want to add anything with respect to FSLR versus EMPH?
Yeah.
Which one?
I think it's kind of clear FSLR is the stronger chart, just kind of looking at them side by side or, flipping back and forth between them. One of them has already broken out of its base. One of them is still, very choppy against that pivot, frustrating a lot of people. I maybe even prefer like SHLS right now to ENPH just because, it's moved a little bit. Obviously it's pulled back recently. But it's a leading group. I think FSR is the leader, and then kind of the secondary names are the other ones.
Yep, and it's been a leader for a while. You could see, you could go to plot the RS phase on it. It's been in a relative strength phase quite a while. You could see on down days it does pulls back much less than the market, especially when the Nasdaq's down a couple of points. It doesn't pull it back as much. So all those characteristics is what you want to look for if you want to be in a leader. In sometime in the future, you want to look for similar characteristics in the market as well.
Yep. And it looked like SHLS had offering after hours, some people are saying. So obviously you want to see how it reacts to that. But it definitely could need some time with this chart and build out above and let the moving averages catch up. Let's see here. You answered that one here. We'll take probably a few more. Let's take a look at, time. We're right at the hour mark here. And if you see a good question, Ray, as well, feel free to jump in. Somebody asked, I enrolled in private access last week. What is the best way to get up to speed? Definitely go over to my courses and check out the Getting Started series, where we basically talk about the market cycle, private access as well, and the TraderLion report. So definitely go ahead and check out those mini courses. That's the best way to get up to speed. Let's see. Yeah, no problem. Kevin asked, could you give an explanation of the BP on the chart, Ray? Maybe you could bring up a screenshot of the BPs and IPs.
Sure thing. Let's see if I can figure it out. Yeah.
And we're not in this webinar, we're not so much going to talk about individual names. I see some people just kind of asking if we could take a look at some tickers. We're kind of more focusing on the larger concepts here.
Well, so I'll share the whole kind of log that we have going to give you guys an idea. So as of today, November 30th, we're now back to +1. We had a recent 12-day upcycle from November 10 to November 12, and the same thing. We broke below the level, and now we're back above it. That's why there's potential for some chop and back and forth here. So you kind of take it day by day. So we'll see what December 1 brings and December 2 and into the weekend. But to give you guys, I think this chart kind of summarizes it well. What you want to do is, right around in these areas, you want to be down. You want to be net short or in a primary cash position. And then in these areas are your oversold rallies, you want to be net positive. At least have one position, see if it works, get to 2. But by the time you get to 2, the market has been in a way where it will slap you in the face and kind of take you out, and you're back, in a new down cycle. So I don't know if that answered the question per se, but let me know, Richard.
Yeah, I think the more they just wanted to see an example of the BP in action and reclaiming the BP, I believe.
Okay.
Yep. And we'll probably just take one or two more after that. Let's take a look here. And feel free to message us on Twitter as well. We're happy to answer questions there as well. My handle is at Richard Moglin. Ray is at RayTL_. That underscore, I hate that underscore, but it is what it is. Let's see here. Yeah, and we'll be, by the way, this is 100% recorded. I'll post this to the YouTube channel tomorrow as well, so you'll be able to rewatch this as many times as you would like. Yep, no problem, Chad. Oh, this is a good question from Nathan here. Whenever you're ready, Ray.
Yep, I'm ready.
Yeah, so the question is basically, how long do you typically wait for the trend to develop before changing your bias? That is, how do you distinguish between a few days of chop and a consistent trend?
I think it's the action of the leaders that will kind of tell you, because most of this year we've seen oversold rallies, to be honest. Like, yes, you could say biotech is this, but you're really trying to, the system telling you to be bullish. You put on that first position. I tend to put on that index position. It gives me some exposure and some time to see how things play out from a leadership and an individual name perspective. And it still gives me a little bit of exposure in the market at the same time. But um, most of the times, again, Ross will say this again and again, leadership will tell you if this is going to last or it's just a few day thing, to the upside, and it will eventually roll over right back down. So I would look at the leadership. If you have a couple of groups and you say, okay, solar, oil and gas, uh, and the biotech space, if they're all going, that's three good groups all pointing in one direction. Yes, we'll get, a 20-day upcycle. There's potential for that. And that is also something that you could add to your framework. You could say, the we're beginning the cycle. You can document in one of the columns, you could document and say, these are the amount of leadership groups that we have a definitive way of, kind of defining what a leadership group is in the first place. You can consistently document that, and you'll see over a span of 1 to 3 years, you'll always see that the bigger market cycles always have better leadership groups or more leadership groups than ones that, a 10-day positive cycle will only have maybe one group, which is the oil and gas group, which we've seen at times while during the summer we saw that big pullback, most of the summer in that 60-day down cycle on our end.
Yeah, I think we'll pretty much leave it there. Any kind of last words you'd like to leave everybody with, Ray?
No, I think watch the pullback, watch this, whatever you define as leadership, watch that on the next pullback in the market. If we do, try to develop this trend and go up the right side on the indexes, it will become overwhelmingly obvious. You don't need anybody for it. You just need to focus on what your system says, what evidence that you're collecting, and then build your own conviction from those steps so that you can continuously go through the paces to build your own framework, build your own system, and operate upon it rather than biases and opinions every single day.
Yeah, perfect. We'll leave it there. Thank you guys all for tuning in. We really appreciate it. Great questions as well. And definitely go ahead and take advantage of that Black Friday sale, especially with private access if you guys are interested in it. And yeah, thanks again for tuning in. And yeah, we'll see you guys over on Twitter and YouTube. And if you're watching this on YouTube, leave a like and subscribe as well to the channel. So with that, have a great rest of your night, guys, and take care. Bye.